The waiting period for Indian investors during a market downturn depends on several factors, including economic conditions, policy changes, global market trends, and investor sentiment. Based on historical trends and expert predictions, here's a breakdown of how long investors might need to wait for a bull market to return. 1. Historical patterns of market recovery. 1. 2008 global financial crisis. Market fall. Sharp 60% decline. Sensex dropped from $20,000 to $8,000. Recovery time, 2 years, back to previous levels by late 2010. 2. 2020 COVID-19 crash market fall. 40% decline. Nifty 50 fell from 12,000 to 7,500. Recovery time, 1 year, recovered by mid-2021. Lesson. Historically, the Indian market has bounced back within 12 to 36 months after major corrections. 2. Expert predictions for 2025 and beyond. 1. Short-term outlook, 6 out of 12 months. Cautious recovery. Markets are expected to stay volatile until mid-2025 due to global uncertainties and the outcome of India's general elections. Factors to watch: interest rate cuts, fiscal policies, and corporate earnings growth. 2. Medium-term outlook, 12 to 24 months. Gradual uptrend. Analysts expect Nifty 50 to reach 24,000–25,000 by the end of 2025, indicating a potential return to a bull market. Sectors to watch: banking, infrastructure, IT, and consumption-driven industries. 3. Long-term outlook, 3 to 5 years. Sustained bull run. Predictions from Morgan Stanley suggest a 20% annual growth over the next 5 years, potentially marking India's longest bull run. Growth drivers: strong domestic demand, policy reforms, and increasing FDI, foreign direct investment. 3. Key indicators, signaling a market rebound. 1. Interest rate policy changes. Lower interest rates by the RBI can boost corporate profits and market sentiment. 2. Foreign institutional investment, FII. Inflows. When FIIs return to Indian equities, it often kickstarts a new bull run. 3. Economic recovery signals. Improved GDP growth, employment, and consumer demand point to market recovery. 4. Corporate earnings growth. Sustained double-digit earnings growth across key sectors will push the market upward. 4. How should investors approach the waiting period? 1. Stay invested. Avoid panic selling. Historically, the biggest gains happen right after a downturn. 2. Increase SIPs. Use market lows to accumulate more units through step-up SIPs. 3. Diversify portfolio. Invest across equity, debt, gold, and global markets for risk management. 4. Focus on quality. Prioritize large cap and blue chip funds for safer, long-term growth. 5. Be patient and disciplined. Market recoveries take time. Adopt a 3–5 year horizon for maximum benefit. Final thought. While short-term uncertainty exists, the long-term outlook for the Indian market remains positive. Investors with patience and discipline during the waiting period are best positioned to capitalize on future bull runs.